Well, good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Coming to you from sunny and toasty Palm Springs and the greater Coachella Valley area. I know there's a heat wave here in the western U.S. Here today, last I checked, we're at 116. We're supposed to peak out at 117 in about an hour or so. But then the good news is we're going to cool down by next Wednesday. It should be down to just over 100, around 102. So it is a little hot out here, but you know what else is hot is mortgage rates. Mortgage rates continue to hang in there. We're seeing a little bit more improvement even this week over last week. As you know, we like to start off by giving you an update by looking at our rate grid on our mortgage website, our MortgageWorks website. So Jeff's going to pull it up right now. And it's interesting, today on Thursdays is when the Freddie Mac issues their weekly interest rate indication, I call it, where this morning Freddie was saying the average 30-year conventional mortgage is at 6.35. Well, I got news for you. If you look at our rate grid, a 30-year fixed conforming loan, again, for a good credit score, decent down payment size, we're actually at 5 7/8. And by the way, that's with no points. And then, of course, what I'm really excited about too is those temporary buy downs, the conventional temporary buy downs, a 3-2-1 with a note rate at 5 7/8. We can actually offer a first year rate at 2 7/8. That's going back to our good old days of 2020 and 2021. The other thing that's nice when you look at this rate grid, 15-year fixed, 5%, no points. So it'd be great to see that break the 5% barrier and go into the fours. And then the other pretty good news is those FHA and VA loans. FHA, of course, is one of, if not my favorite loan product, down to 5 1/4 with no points. In fact, if we do a 3-2-1 buy down off of an FHA loan at that note rate for a purchase loan, you're talking about a first year rate at 2 1/4. Again, harkening back to those 2020 and 2021 days of 2 to 3% mortgages. So mortgages are doing really well. I call them hot rates. If this doesn't get you off the fence in terms of either purchasing a home or a refinance, we need to talk because there's an opportunity here, and I don't think you want to pass that up. So what's going on? What's causing this to happen? We like to give you a 5-day chart of the 10-year bond yield. There it is. And there you can see that nice decline that really started on Tuesday after the Labor Day holiday. And so what was going on there to cause that decline over the last couple of days? Well, early in the week, the data points, the economic data points that helped bring those that 10-year bond yield down was a couple of things. First, on Tuesday was the ISM Manufacturing Index. That's the Institute of Supply Management. They do this manufacturing index, and it came in at we call it a negative number, 47.2%. Anything below 50% is considered contraction or a reduction in growth. It's a negative growth, actually. And then the other thing on Wednesday, JOLTS, that's the job opening labor turnover survey, lowest in 3.5 years, only 7.7 million job openings. Not too many months ago, if you've watched this show, that number was over 9 million. What is that suggesting? Many companies have less job openings. That suggests there's a tightening of the labor market. As I put there, it's becoming harder to find work, to find a job, because the number of new job openings or new job offers has declined quite a bit. So again, those two numbers, manufacturing index, JOLTS, is suggesting we are seeing a softening market, and in particular with JOLTS, a softening labor market. And that's probably what the Fed focuses on more than anything right now, is the job market. So what do we have coming up? Well, today we had the initial jobless claims ticked up slightly, 227,000 from the 225 forecast. That's still below what it was last time when it was 232,000 jobless claims. And then the ISM Services Index, again, Institute of Supply Management Services Index, that actually showed growth, 51.0% forecast. It actually came in at 51.4. So that's, again, it's kind of odd. Mixed signals, right? Manufacturing's contracting, services are still growing, but growing at a less rapid pace. And so I think what we have to look forward to for the rest of the week, which is basically tomorrow, and I think most market observers call this a crucial couple of data points. It's all about the jobs report and the unemployment rate. For the jobs report, it's predicted or forecast that we're going to see 161,000 new jobs. Well, as it turns out, ADP, the payroll company, they do their own survey of new jobs. I don't like their survey that much. I don't think it's as accurate as the government numbers that are released tomorrow. But ADP was out this week saying they only saw 99,000 new jobs. Obviously, that's very weak. So we'll see what the U.S. government numbers are tomorrow. If they miss this forecast of 161,000 and it comes in lower, or particularly if it comes in quite a bit lower, we could see a situation like we saw a couple of weeks ago where that 10-year bond yield could rally downward, and we could see some decent further improvement in mortgage rates. And of course, the other thing to come out tomorrow is that unemployment rate at 4.2%. If that ticks up to 4.3 or 4.4, again, that would be another strong signal the labor market is softening. And that, unfortunately, maybe not good news overall in terms of the economy and the potential risk of a recession. But as we've talked about before, in the mortgage industry, sometimes poor economic news, particularly as it relates to the jobs and recessionary conditions, unfortunately or fortunately, depending where you're at, if you're trying to buy a home or refi, that can be good for mortgage rates. So tomorrow is going to be a key and possibly crucial day to see what direction we go to from here. So with that, we're going to go ahead and go into our next segment where Jeff and I are going to discuss some more regarding the refi boom that is perceived to be out there, and then specifically impound accounts and what role do they play if you want an impound account on a refinance, as to evaluating that refinance from both a tangible benefit standpoint as well as a cost recapture standpoint.
Hey, Art. Sorry, I was listening for those key words of I'm going to bring Jeff in and we're going to talk about this.
Sure.
So yeah, before we started, we were talking about impound accounts, and you said you believe setting up an impound account for a refinance loan should be ignored when evaluating the benefits of a refinance. And I'm just curious why that is.
Well, it's a good question, and it's something that I end up talking to homeowners about all the time when they're evaluating a refinance. And it goes back to we had done an earlier segment on our program where I talked about closing costs and trying to identify what the true cost of getting a loan is, and that's whether it's a purchase or a refinance. And I tried to distinguish between what we call non-recurring costs, which those are ones that are what I call third-party fee-based costs for services provided by service providers, such as appraisers and credit report companies, escrow and title companies. And then you have your recurring costs, which are limited to prorated interest on the new mortgage you're going to get, and then funds that you have to put up for either homeowners insurance homeowners insurance and taxes. And so when you're looking at a refi, you can get a little bit of a head fake, because when you see a worksheet, like if we send you a worksheet to give you all the numbers, or if you get an actual loan estimate after we've registered your loan and it's sent to you to be signed, both the non-recurring costs and the recurring costs are lumped together and are called generically closing costs. And so many borrowers will look at that total number, which can be quite large, and say, wait a minute, this refinance is costing me too much, because it says it's going to cost me $10,000 to refinance that loan. Well, when you dig deeper, what you find, and what I help people realize and show them, is that closing cost number, in a lot of cases, particularly this time of year, more than half of that number is not third-party fee-based costs at all. It's what I would call, and what we tend to call in the industry, advance funds that have to be provided to set up the impound account for the new loan that you're refinancing into. And so when you realize that, then that changes your perspective as to how much that refinance transaction is really costing you. And then I think once you grasp that, then you realize is that impound account really should not be a factor in evaluating whether or not to do the refi.
Well, I'm curious, in your title, you call it tangible benefit. What exactly do you mean by that?
Well, yeah, that's a very good question. And part of it has to do with what I just said. You don't want to consider the impound account money that you have to put up during your refinance as a closing cost that might, in your eyes, in your mind, diminish the tangible benefit of doing the refi. Now, technically speaking, a tangible benefit in the mortgage industry when you're pursuing a refinance of your loan has to do with actually several specific things. One is, for a tangible benefit test to be met, we have to establish that you're going to save some money on a monthly payment. Now, that's true if you're doing what we call a rate and term refinance. You're not getting cash out. You're simply trying to refinance to get a lower rate and a lower payment. There is generally going to be some minimum amount of monthly payment that has to be achieved in order to meet what's called a net tangible benefit. And with some loan programs, that improvement only has to be, believe it or not, as low as about $50 a month. With some programs, such as an FHA loan, a VA loan, that tangible benefit would be defined as having a new interest rate, again, if you're going from a fixed rate to a fixed rate, of at least 0.5% or more. But there are other tangible benefit tests that would establish that it is a benefit to refi. For example, if you're going from an ARM loan to a fixed, even if the fixed rate loan has a higher rate, it's still considered you're getting a tangible benefit because you're getting out of that variable rate loan and going to a fixed rate loan. Another tangible benefit is if you're going fixed to fixed, but you're going from a 30-year term to a 20-year term or a 15-year term. That usually will mean a lower rate, but your payment could be the same or higher than your 30-year loan, but because you're shortening your term, that's a tangible benefit. And then, of course, the other major tangible benefit is if you're going from your existing loan and you want to refinance, maybe to lower the rate and the payment somewhat, but you're also pulling cash out. Well, if you want to pull enough cash out to the point where your new payment's going to be similar or even higher than what you're already paying now, even if the rate is higher than what you're going to get with that cash out, it's still considered a tangible benefit. So with all those tests, what you still need to realize is the money that you have to provide during the refinance transaction to set up the impound account for both for taxes and insurance should not be a factor in establishing or evaluating if you're achieving a tangible or a net tangible benefit.
You know, another question on that, and thanks for taking that and really clearing it up. But what about, when you talk about the impound account or the cost of the refinance, let's talk about the recapture costs from lowering the rate or payment. How do you figure that out?
Well, again, what tends to throw people off all the time, and I spent a lot of time going through this in detail with a homeowner. This is actually, refinancing, the refinancing transaction in the mortgage industry is now very prevalent. Again, I've talked about, all the years I've been doing this, 40 years ago when I got in the business, refinancing was not a real significant part of the overall mortgage industry. Refinance volume versus purchase volume was generally pretty low. Of course, when I got in the business, I started off offering 17 and a half mortgages, and it took several years even to offer something under 10% and get into single digit. But nonetheless, even despite where the rates were at, refinancing was just not a common transaction overall. Now it's very prevalent. I think the general public, homeowners in general, are very privy to the refinance opportunity. And so they always have their kind of antenna up to look for that opportunity. But and in that regard, what most homeowners realize is you want to take a look at what's it going to cost you to do that refi? What's the new rate you're going to get if your intent is to refi to lower your rate? What's the new rate you're going to get? What's the monthly payment you're going to get? And then calculate what that difference is. How much are you going to save per month? Is it $200 a month? Is it $300 a month? Is it $150 a month? Is it $400 a month? Whatever that number is, what you then want to do is compare that monthly savings in payment against what it's going to cost you to get that refinance loan completed. And what I always try to remind people is when you're looking at the cost side to calculate that recapture period, again, exclude the impounds. In fact, really exclude all the recurring costs, prorated interest, and again, the impound account advance money for insurance, the impound account advance money for taxes, or if you're closing a refinance at a time where your insurance is up for renewal anyway, so you end up having to pay that 12-month renewal premium and then provide another 2 or 3 months to set up the impound account. You should ignore all that in terms of calculating your recapture period, because you're going to have to pay those taxes and insurance anyway, and it's not related to the loan per se. You could pay off your loan and you're still going to have taxes and insurance. So when you're calculating that recapture period, you want to only look at those non-recurring third-party fee-based costs that are going to be incurred by pursuing the refi. And I pointed out on this program before, with most loan balances, 3, 4, 5, even 600,000, the again non-recurring third-party fee-based costs, assuming you're getting a rate with no points, no discount points, no loan origination fee, you're just paying third-party costs. Your actual cost should be somewhere in the 3, maybe 4,000 range if you get that loan amount higher, 600, 700, 800,000. Well, if you're saving $400 a month, you can recapture the cost, the true cost of that refi in less than a year. And that's the appropriate and accurate way to calculate your recapture. If you try to lump in your impound account deposits, which could take those non-recurring costs from 3,500 to $9,000, well, then you're falsely calculating a recapture period that's too long because you're not basing it only on fee-based charges related to getting that refinance.
It seems like that's a real easy thing to, I'm going to call it, from the land of golfing. That's an easy thing to whiff, isn't it? I mean, we say, hey, we just see that big number at the bottom, or that number, whatever that is. And we say, well, how long will it take at saving $350 a month? But like you said, it goes another $9,000 up. And we're saying, well, geez, it's going to take, 2.5, 3 years to recover this. Maybe it's not a good idea.
Right.
But one thing you point out is, when we think about impound accounts, and stop me if I'm wrong, maybe I should have just had you say define what an impound account really is.
That's actually a good question. We're jumping into this assuming everybody knows. But yeah, let me cover just the basics of that. An impound account, which, by the way, in some parts of the country, like back east in particular, they're often known as, in fact, even here in the West, here in California, when you get your mortgage statement, you'll often see that it's not referred to as an impound account. It could be referred to as an escrow account, which can get really confusing because here in California, we have escrow companies. So you're going, escrow company, escrow account, what does that all mean? Well, basic concept with an impound or escrow account is that when you get your loan, you decide that you want to have the lender disperse the future installments of your property taxes as they come due, which in California twice a year, or your homeowner's insurance policy, which of course typically renews every 12 months. So you make a decision that you want the lender to disperse the funds for those installments as they come due. So in order to do that, you've got to, when you close your loan, set up the impound account, and you have to fund the account for both the insurance and taxes with some amount of money up front, so that at the next installment as it comes due, that initial advance amount plus however many monthly payments you are going to make after the loan's closed before that next installment is due, there'll be enough accumulated by the lender to actually pay the installment for you. And the amount that you have to provide up front can be higher or lower depending on the time of the year that you're setting up that impound account, just because of how soon the next installment is due. But once you set up that account, then what's happening is your monthly payment to the lender is not just principal and interest, it's principal, interest, taxes, and insurance. And then what the lender does is pulls out of that monthly payment the insurance piece, the tax piece, and puts them in the impound account, what they call them buckets, for insurance and taxes. And then each month as you make that payment, those buckets accumulate with a higher balance, so that when that next installment is due, for example, property taxes are coming up, the actual due date is November 1, but not delinquent till December 10. So what happens is most lenders don't disperse that next installment until very late November, even maybe the first couple of days of December. Well, if you're closing a refi now, you're not going to have 6 months monthly payments made in order to have the lender have that money available to disperse. So that's what triggers more money up front.
I think that helps clear that up, because when we think closing costs, we think this one-time fee. But when you break it out into, okay, there's true closing costs, because those are fixed, non-recurring, and recurring, but calling it impound accounts, it makes so much more sense. It really clears it up. Thank you for doing that, Art.
Well, and one other thing I'd note on that, just because I just alluded to it, is how the impound account advance funds can change significantly depending on the timing of the year when you're doing your refi. In fact, we're entering a period here, August, September, October, where if you pursue a refi now, you're going to have a pretty large chunk of money you have to put up front. I mean, it can range now from about 6 months in August to 8 months if you close in October.
Wow.
Why does it have to be 8 months? Well, if you close in October, your first mortgage payment is until December 1st. And if you're making one payment on December 1st, obviously that lender is not going to have 6 months of taxes accumulated to pay that next installment that's delinquent after December 10th. So what you end up having to do is when you close that loan in October, the lender is going to say, you got to give 8 months of taxes when you close that refinance. That money goes right to the lender. And then that way they've got enough to cover that 6 month installment. And of course, why do you have to put up 8 months instead of six? Well, because they're allowed a cushion of 2 months.
Mm, mm.
So as a consequence, that's why these next couple of months, when you close a refi, when you look at that loan estimate and the non-recurring and the recurring are all lumped together on a line item for closing costs, you go, oh my God, it's going to cost me $11,000 to do this refi. No, it's going to cost you 3,500 maybe. But the rest of that, 6,500 or 7,000 is all about that advanced funds for the 8 months taxes. And if you're the double whammy is if your homeowner's insurance is due to renew in November, then you got to pay 12 months insurance when you close the refi, plus another 3 months to set up the insurance impound account. So
Wow.
that's why it's a real head fake, and you've got to understand that aspect of it. And then of course you have to decide how you want to provide those funds. Some homeowners will simply decide to roll that into their new loan amount, which actually what that means is you're financing that next installment of those advanced funds for insurance and taxes into your loan. If you're getting a 30-year loan, you're essentially financing it over 30 years. Whereas with other homeowners, they'll say, I don't want to increase my loan amount for that portion of this transaction. I recognize it's not fee-based charges to me. I've got the money in the bank to cover that. So we'll set their loan amount at a level where it's going to cover all the non-recurring costs as well as their existing loan payoff, but then they'll provide the funds to escrow at closing so that way their new loan amount isn't raised even further just to cover that initial expense because of the timing of when the next installments are due.
Now, I do have to ask you this question. So let's say, for instance, if I, the homeowner, I've already had an impound account on my current loan, and now I set up a refinance with you. What happens to that impound account that was over here? Why don't they just transfer it to the new loan?
Well, that's a good question. Now, so you're hitting on something that in the old days used to be a common practice.
Mm.
In the old days, what would happen with many lenders is, and again, well, let me use this October example. If you're closing a refi in October, well, in the old days, of course, in October, if you already had an impound account on your existing loan, there's going to be quite a bit of money sitting there. The reason being is it's been accumulating over the last several months' payments, and the balance has risen to the point where the lender's going to be able and ready to start dispersing that next 6 month installment of taxes. And if your insurance is renewing somewhere in the fall, like November, they're getting ready to disperse that as well. Now, in the old days, all that money sitting there, when they're asked to provide a what we call a payoff demand statement by the escrow agent handling the refi, they would apply that impound account money toward the payoff of your existing loan. And that, of course, meant you could have a lower new loan amount, although then you might still raise that to cover the new advance funds for the new impound account. That practice usually, for the most part, isn't done anymore. So what happens is you're going to still have to provide the advance funds depending on when the timing of your closing is. And again, if it's October, you're talking 8 months taxes and potentially as much as 15 months insurance. Well, gee whiz, if you close your refi in October, that existing money that's accumulated in your old loan is sitting there. And would have been used for that next installment, but it didn't get a chance to because of the timing of when you close your new refi. But guess what? Good news, it's found money. What happens is when your old loan is paid off, and if that impound account balance, which has grown substantially, hasn't been dispersed, it was about to, but it didn't get a chance because you closed your refi a tad earlier than the installment due date. Then after that loan's paid off, you're going to get a check in the mail, probably within a couple of weeks. And that could be several $1,000s depending on what your property tax, annual property tax amount is, plus of course insurance. So that can be a factor as well when you're having to close your refi and you have this advanced funds you have to provide. Well, once I point out to the homeowner, hey, let's look at your impound account balance and your current loan. And if it's a substantial number, that can help them decide to adjust their new loan amount, not to finance the new impound account advance funds into the loan. They'll provide that cash out of pocket, knowing that within a couple of weeks after they pay off the existing loan, they're going to get that existing impound account balance back. And we can even fine tune that to the point where we set their new loan amount such that they provide advance funds for the new impound account out of pocket, and we adjust the new loan amount so that the amount of advance funds they have to provide out of pocket roughly equals to the expected refund of the old impound account that's going to come within, again, a couple of weeks after they close the refi. So that's a way we can really dial into the numbers and help them optimize what their new loan amount is, and at the same time not have a financial burden of having to provide those advance funds.
I think that's great. We did this a few years ago where we refinanced our home, and we had a situation like that. And I'm sure it was disclosed to us. This is before we knew each other, and it was a surprise that all of a sudden, like you said, a couple of weeks from the time we closed, we got this check in the mail. I'm like, are we supposed to have this money? What is this all about? Because I don't recall with everything that went on that was actually disclosed. So it was a nice surprise. So
yeah, and and that's what that exemplifies is a lot of folks who do what I do. I don't know, maybe they just forget, but they don't think to let the homeowner know about that little surprise. I always make a point of letting them know because, again, it can be a helpful factor when they're dealing with this other surprise of, oh my gosh, I got to provide 8 months taxes and 15 months insurance to close my refi. That's a lot of money. How am I going to handle that? Well, this is a way to let them know they've got an option that's going to make it a lot easier to deal with.
I like that. Well, Art, thank you so much. Today, we've been talking about impound accounts and the tangible benefit and cost to recapture that with Art Alvarez. He is the answer man. If you need more information, here's his information here at Mortgage Works. His office is 760-969-5023. And of course, you can always reach out to him on his cell at 714-612-9035. Art, thank you so much for clearing us up about impound account. It makes a lot more sense. Thank you.
That's good. Thanks, Jeff. Good discussion. Okay, everyone, we're going to move on to our next segment. As you know, we always like to talk about the closing question from last week. The one we had from last week is pretty good, and Jeff's going to pull it up here. There it is. With rates dropping, we anticipate refinancing soon. A lot of talk about refinancing. Again, folks, we're in the fives, low fives for FHA, VA loans, so keep that top of mind. There's a refinance opportunity, as well as purchase loans, by the way. We're in the fives, take advantage of that. But with that said, with rates dropping, we anticipate refinancing soon and have heard there is a no closing cost option. Wouldn't that be the best choice to optimize the benefit of refinancing to a lower rate or to lower our rate? Well, I have an interesting answer there, and you can see it at the top bullet point. I agree it's the best choice for the mortgage loan originator. Okay, what does that mean? Why do I say that? Because otherwise, wouldn't it be obvious that if you can get the loan, you get your loan refinanced at no closing costs? Wouldn't that be obviously the best choice? Not exactly. So let me explain why. First thing to understand is there's no such thing as a no closing cost loan. There are going to be closing costs. There are many service providers involved in arranging that mortgage loan, including on a refinance. You're still going to have an appraiser. You're still going to have a credit report company. There could be a third-party vendor providing an employment verification. There could be a property management company for condominium development who's got to provide some documents that's going to cost some money to get them. They're going to charge for that. There's going to be an escrow office, a title company. They're going to charge fees for escrow fee and title reports and so forth. So closing costs exist. There's no such thing as no closing cost. What matters is how they are paid. The closing cost refinance pitch, I'll call it a pitch, is simply a function of you're going to have those costs paid through the interest rate offered to you. In fact, there's a well-known company here in Southern California. You don't hear from them much now. They would because rates have been high. But in a low rate environment, they're all over the radio advertising. You're not going to pay one dime out of pocket for any closing costs. It's the greatest thing in the world since sliced bread, all that kind of nonsense. Well, all that means is they're going to offer you a rate where the closing costs that are real are being financed into the rate. What that means is you're going to be hired. You're going to be offered a mortgage rate for the no closing cost scenario. It's going to be a little bit above market. What that's going to do is create what we call a net lender premium or credit. And they set the new rate being offered to you. Now that new rate may be still, possibly even significantly below your current rate, but they're going to raise it slightly above what you could get if you just went with 0 points rather than no cost. And so that higher rate creates a net lender premium, and then they apply that to all those third-party fee-based costs. Now, the reason I think that's not the best option is because in most cases, the homeowner has enough equity that what I observe, and I show them the numbers so they grasp what I'm talking about. I think you're almost always better off finance those true closing costs into your loan amount, not into your rate. Why would I say that? Because you're going to get a lower rate offered to you, still going to be at 0 points, but those third-party fee-based costs are going to be paid for out of your new loan amount. That lower interest rate versus the no-cost option is also going to provide you a lower APR, and you're going to have a lower principal and interest payment. And by adding it to the loan amount, the new loan amount, does that affect your monthly payment a little bit? Of course it does. But remember, each $1,000 of loan amount at current interest rate levels is about $6 a month. Well, if you have to add, $3,500 to your loan amount to cover those non-recurring third-party fee-based costs, that's about $19 a month. Well, if you end up getting offered a quarter or 3/8 higher rate in order to cover those third-party non-recurring costs, that quarter or 3/8 in rate is probably going to cost you a lot more than $19 a month. It's probably going to cost you, depending on your loan amount, 50, 60, $75 a month or more. So obviously, when I present it this way, the light goes off with most homeowners. They say, you're right. I've got the ability to put those costs in my new loan amount. I'm going to do that and not into the rate. The reason I think it's better to do it that way is a no closing cost option means if you pursue it, you're going to probably be refinancing more often in an extended declining rate environment. Back, previously when we were seeing that kind of environment, a lot of originators would push the no closing cost option. So they'd still give you a better rate than you had now. You'd close that loan. You're probably getting a quarter, 3/8 higher than a market rate with no points. And then what happens is when rates fall a little bit further, maybe as little as 3/8, maybe 0.5%, for a new no closing cost scenario, they'll come back to you and say, hey, let's refinance again. I got all your information. This is going to be easy to do. And let's do another no closing cost refinance for you. And they'll literally have you refinance several times at 3/8, quarter, 3/8, 0.5% increments. Because why? Why wouldn't you? There's no closing costs. Well, what that serves, in my opinion, that serves the mortgage originator more than you, because obviously every time they originate that no closing cost loan, they're getting paid. So again, if you're looking at a refi, I caution you about the no closing cost option. I've had that debate with some homeowners when I've arranged refis, and even after I present them my opinion, they still want me to do the no closing cost refi. I have done them. I'm not going to say no, obviously, but I want you to have a full understanding of what the two options are. And in my opinion, financing your closing costs on a refi into your loan amount is going to be long-term a much better option for you, and it's going to allow you to refinance a lesser amount of times in that declining interest rate environment if it's declining over an extended period of time. So hopefully that helps clear up the choices between those two options. Good questions. So with that, we're going to go ahead and go to the closing question for next week. And this is a good one. Currently, our credit scores are 680 and 690. If we were to improve our interest rate for a new home loan, how much would they need to improve to see a better rate, and how much of a payment difference would that make? Or should we lock in a rate now and then begin credit improvement and come back to refinance? That's an excellent question. There's a lot of information, a lot of material there to dive into. So looking forward to going into this subject with you in greater detail next week. So in the meantime, That concludes our program for today. I want to thank all of you for watching and listening to this week's Mortgage Minute. Try to stay cool out there. We got a hot week here for the next few days. And again, have a great weekend. And we'll see you again next week. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. So long. Take care.